Welcome to The Explainer. Today, we're going to dive into a really fascinating and honestly, often misunderstood part of the investment world, managed futures. So let me just start with a big question. What if there was an investment strategy that was actually designed to do well when everything else is falling apart? A strategy that doesn't just survive a crisis, but might actually see it as an opportunity. Well, that's pretty much the whole idea behind managed futures. See, it's a strategy that doesn't really care if a market is booming or busting. All it cares about is if there's a clear trend. The whole game is to catch that momentum, whether it's going up or down, using these incredibly flexible tools called futures contracts. Okay, so how does it actually work? I want you to think of it like surfing. These fund managers aren't trying to create the waves, they're just trying to ride them. Which brings us to our first section, surfing the market waves. At its heart, the goal here is all about one word: diversification. For decades, investors have been on this hunt for assets that don't just copy whatever the S&P 500 or the bond market is doing. Managed futures try to be that missing piece of the puzzle, giving you a totally different stream of returns. And this flexibility is absolutely key. These managers aren't just trading stocks. Their playground is literally the entire globe. They're jumping into stock indexes, government bonds, currencies, commodities, and they've even gotten into some really exotic stuff, trading futures on things like the weather or carbon emissions. This incredible flexibility lets them hunt for trends just about anywhere. But does that make it the perfect solution for any market condition? Is this thing truly an all-weather investment? Well, this is where the strategy really earned its stripes. Back in the 2008 financial crisis, while most people's portfolios were just in total freefall, a lot of managed futures funds were actually making money. They did it by shorting stocks, basically betting they would fall, and going long on government bonds, betting that investors would rush to safety. Just look at this slide. The contrast is unbelievable. In 2008, the S&P 500 tanked by 37%, but the average managed futures fund was up 14%. This ability to give you this powerful upside when everything else is crashing, that's what the experts call positive skewness. To put it simply, it's like a form of portfolio insurance that can actually pay you. So how do they pull this off? Is this all based on some manager's brilliant gut feeling? Almost never. The vast majority of these strategies are super systematic, just relying on computer models. So let's peek inside those models. These models are almost all based on recognizing patterns, specifically momentum, which really comes in two main flavors. First, you've got time series momentum, or TSM. This is an absolute bet. It just looks at one thing, let's say gold, and asks, is its price trending up? If it is, the model says buy. Is it trending down? The model says sell it short. Simple. Then there's cross-sectional momentum, or CSM. This is a relative bet. It compares a whole group of assets, like all the precious metals, and tells you to buy the best ones and sell the worst ones. And here's the crucial thing to remember. While both types of models are out there, the vast majority of managers use that first approach, time series momentum. They're making these simple directional bets on the absolute trend of individual assets all across the globe. But the tool that makes all of this possible, the thing that lets them make these big directional bets, well, it's a classic double-edged sword. Let's talk about leverage. See, when you buy a stock, you own a tiny piece of a company. With futures, it's totally different. You're not actually buying barrels of oil or bushels of wheat. What you're doing is controlling the exposure to their price moves for a tiny fraction of the total cost. This idea is called notional value, and it's what makes the whole strategy so capital efficient. To put this into perspective, let's say you wanted to buy stocks on margin in the US. You typically have to put down 50% of the value yourself as collateral. Now, with futures, that number just plummets. The required collateral or margin can be as low as 5%, sometimes even less. This means you can control the exact same amount of market exposure with way less capital. So the result is this built-in, massive leverage. It's what allows for those potentially huge gains when you catch a trend just right, but it also means that tiny price moves against your position can lead to equally massive losses. The risk gets amplified right alongside the potential reward. Okay, so with this unique profile of high leverage and trend following, what does the future actually hold for this strategy? This brings us to some pretty big challenges ahead. Yeah, it's not all been smooth sailing. For one, performance is cyclical. The strategy had a really tough time between 2011 and 2018 when a lot of markets were just choppy and didn't have any clear direction. Then there's the problem of overcrowding. As more people use similar models, the signals can get weaker. But maybe the biggest challenge of all is the zero yield problem. For decades, a huge chunk of returns came from a simple, reliable trend, just betting on falling interest rates. But what happens now? After years of interest rates being pinned to the floor all over the world, that epic, multi-decade trend in bonds is over. Can managers still make reliable money from trend-following bonds if rates start to rise from here? It's a completely new world, and it's the central question facing the entire industry. So that leaves us with the big picture. Is managed futures a powerful, almost essential tool for diversifying and protecting a portfolio during a crisis? Or is it a strategy whose best days are behind it, facing a really uncertain future now that some of those old reliable trends are dying out? The answer is probably going to shape institutional portfolios for years to come.